in up markets and down markets. A great looking deal on paper can strike out and be a problem, and a shy deal that looks like it's barely going to make its target return becomes a massive home run.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. We've got another great show for you today. Today we're joined by Mike Zlotnik. Mike is known in real estate circles as Big Mike due to his stature, but more importantly, he's known for his personal integrity and for having a keen understanding of the financial aspects of successful real estate investing. Mike has a depth of expert knowledge in economics and investment opportunities in real estate. What's hot, what's cold, and where things are trending now. Mike, welcome to the show.
Dave, thank you so much for having me. Honored and humbled to be on your show. Appreciate the opportunity to be here.
Yeah, absolutely, Mike. I know the audience is really going to enjoy this conversation. There's so much uncertainty into the market right now. As we record this, it's Q1 of 2023. Are we moving into a recessionary period? Interest rates, right, on the rise, although the Fed only hiked a quarter point just this week. So that was kind of interesting. So lots of dynamics going on in the marketplace. And, a lot of investors are wondering, what makes sense on the investment horizon. But before we jump into kind of economics and everything, tell the audience a little bit about your background, your journey, and your story.
Sure. I live in Brooklyn, New York, with my lovely family. As I like to correct this joke, I'm married to my lovely wife. I have four monkeys and a cat, 4 human monkeys, 4 kids. The broad range from 22 to 12, so they've kind of not small kids anymore. I had a journey. I came to the United States as a political refugee from the former Soviet Union in 1989. That was that long ago. I'm a U.S. citizen, U.S. patriot. I spent my initial career in technology field. I spent almost 15 years working in IT, various roles, getting all the way up to a senior executive in that field. But my true passion has always been real estate. I've been an investor in real estate since 2000, enjoyed being a passive investor for 9 years, and then went full-time in 2009, becoming a basically fund manager, and we've been running a family of funds, Temple family of funds, since 2000. And it's been a fun journey. We've done a lot of loans, we've done a lot of commercial real estate. So we've built a lot of expertise in a broad range of commercial assets, and I don't claim to be a jack of all trades. At the same time, over the years, we've invested into multifamily, storage, industrial, office, shopping, a number of other asset classes. So I actually like the broad diversification strategy because you don't know what's going to be a home run and what's going to be a strikeout.
Great. And so do you actually have a wealth strategy that you're following today?
So we build wealth through our own dog food. So we invest into a lot of things that we love. Like Warren Buffett, I don't want to be diversified into 100 deals, but the deals where we select, we take a little bit bigger positions ourselves, and obviously our investors participate in these investments. So the wealth strategy is not like a holistic wealth strategy. It's more of opportunistic. We've been building our portfolio of real estate assets as the primary wealth building mechanisms for multiple years. So I certainly, I'm not an expert in stock market, but I do love the investing in real estate and the benefits and one word of predictability of investing in real estate. So my personal strategy has been growing wealth through various investments in real estate assets, from loans to equity positions. And I can tell you that I've grown and discovered that building a portfolio of turnkey properties is not for me. I started that whole exercise, built a portfolio of my own, and realized there's a lot of work there. So I would rather own pieces of large commercial assets than owning a bunch of single-family residential houses. I don't know if it helps, but we basically own pieces of many commercial projects, and that's the way we prefer to do it, rather than owning one asset outright. We own 10% of this, 20% of that, 30% of this, and that's the way we've been investing. And diversification is a critical element of what we do, simply because if you just take concentrated risks, we do that, but there's more exposure to what a specific deal can do. And we've seen this in up markets and down markets. A great looking deal on paper can strike out and be a problem, and a shy deal that looks like it's barely going to make its target return becomes a massive home run. And that whole experience has taught me one lesson. Even if you have great conviction to write a big check, you still have to diversify. So even follow the words of the wise of Warren Buffett and Charlie Munger, where they take outsized bets on things they believe in strongly in the right time of the market. That whole strategy makes a lot of sense, but they still diversify. They'll write a $5 billion check when they have $100 billion in the bank. So that strategy still makes sense.
Yeah, and what do you believe is the most important for investors, right, in 2023, right, as they're thinking about capital allocation? What are the most important things people should be thinking about?
Sure. So the question is for the fresh money or for the existing money, because they're different things. For fresh money, of course, some folks are saying downside protection, which is a very important consideration in investing. Another way to think about for fresh money is, can you invest into great distress and discounted deals? So as we're entering into a recession, keeping the eyes and ears open, being very opportunistic, looking for a great deal is the way to start the year. Now, great deals may not be coming today or tomorrow, but they should be coming later in the year. We'll talk about this because there's a lot of pressure that's built up in the economy that's going to cause distress in some of these transactions. So being very opportunistic, having cash or having access to cash is a way to go with fresh capital. Obviously, with existing investments, it's a different ball game, because you have to look at what you got and how these investors will fare in a recession. Is there a risk to a project? So assessment of the existing investments, kind of, can you winterize your portfolio and at least understand your portfolio and be prepared for certain deals to take a hit. And that's a psychological exercise, and it's a physical exercise, because you have to know what you got. If you don't go to a doctor and you don't look at your portfolio and you have, let's just say, 30 investments and 25 of them are solid, but 5 have potential risk of some level of a loss, maybe catastrophic loss, then you can't really plan. So it's important to know what you got. And on the fresh investment side, the opportunity is going to be plentiful. What Fed has done, and we'll talk more about this, but I love to use these words, like the movie. The Fed has acted late, and they were too fast and too furious. They moved the rates up way too fast in over a very short amount of time, when the economy was just addicted to a very low interest rate environment. And a lot of deals, real estate and corporate deals, just have too much debt at a very low interest rates. And when the debt matures, it creates gigantic pressure for the operators or owners, as they're going to need additional capital. They're going to need to sell distressed potentially. So there's a lot of opportunities that could be coming, and being ready and prepared, not fearful to act. I believe that's state of mind and state of a wallet. That's the way to go.
Sure. So for investors who have existing portfolios, right, across, different asset types and everything, are there any particular KPIs that you're following to track your investments and kind of, let's say, stress test them to see how they're performing?
Sure. So the most basic analysis that we do in our portfolio management, we compare both operating and financials versus projections versus the plan, pro formas. This is the most common thing that most operators do. You invest in a value-add multifamily, what were the projections month to month from an operating perspective, how many units were planned to be renovated versus how many were renovated, on budget, on time, on cost, right? And then on the reverse side, on the financials, just looking at the economic numbers, what were the projected NOI, what is the actual? If things are moving towards a target, that's actually good news, right? You're operating from that perspective, executing on a plan. You should absolutely look at the stress points that a given investment might have, like long-term maturity or rate cap expiration. So investments made a couple of years ago, when their interest rates were low, they basically were two possibilities. Unless you bought a stabilized asset, you went immediately as an operator to get a long-term bank loan, Fannie Mae, Freddie Mac, or just a long-term bank paper. And that's wonderful. But if you bought a value-add project, or you invested as an LP with a sponsor into a value-add project, the chances are the project has some kind of bridge debt. And it's not a sure thing. Some folks have taken longer-term loans, and that would have been a great decision, but way too many people have taken bridge. And that bridge debt could be maturing. So most of the rate caps I've seen being bought were up to 2 years. So again, project from 2 years ago could already be expiring on the rate cap, and the rates were substantially lower. So the interest rate that they're paying now versus the interest rate they got, let's just say 1.5, 2 years ago, could be 80% higher. Payment factor could be 100% payment factor higher. That's a gigantic stress point. So for sure, looking at that and understanding, does the project expect to have that sudden payment increase because the rate cap expired? It's a substantial concern. And there's only two solutions. Well, there are three solutions to that, right? At that point, if the deal could be not meeting debt service coverage ratio. So a few options. One, buy a new rate cap. So the bank may say, bring liquidity, bring cash, pay us. You're buying fresh rate cap, and then your interest rate is now manageable, right? Second option becomes raise capital. So you raise capital and you pay down the mortgage, which is not necessarily as attractive, and there would be a lot of capital raised. You could either raise from existing investors or you can raise from new investors. And the third option becomes sell. And sell becomes a concern if you are selling into an environment that's not really receptive to the sale. For example, you have a bridge loan, but you haven't fully executed your value add work, or you had some problem, a hurricane hit, or some other issue happened, and you were not able to execute the plan. You have to wait through the plan. If you're going to sell now, it's going to be looked at as a substantial distress, a discounted opportunity. On a buy side, that's a great deal. On the sell side, it's a pain point. So what we are doing is it's not like a KPI. It is a practical exercise of review stress points. There could be other stress points, but these financial rate increases is a gigantic stress point that is very common. There are uncommon stress points. A project ran into massive operating issues. So that's why the first two things I mentioned, comparing operating pro forma versus actual and financials pro forma versus actual, is important, because they're going to tell you, are you on plan or not? If you're on plan, at least that component looks good. So I hope it helps. This is a general kind of high level type of a view. And the other thing that we do is we want to see good communications. So when we work, because we run family of funds, we basically invest often as LPs, just limited partners. We also invest as GPs, co-GPs, but we work with folks that run these assets. We basically work with operators, and we want to make sure operations are very strong. So, and the decision becomes, depending on the size of your investment, do you want to get monthly updates or you're okay with quarterly updates? So we're gravitating in this environment as much as possible, move to an monthly operating updates and get clarity what's going on a monthly basis. What used to be good enough on quarterly now might need monthly type of review. What else can be done to address if the issues are coming up? And level of communications is very important. What happens is this: when things are going well, operators and sponsors communicate well. When you see some kind of drop in communications, it typically signals something is up. This is human nature. I've seen this again and again, and I mean this with all due respect to all these operators. When there's some kind of stress level happens, people start under communicating, and then you got to go figure out what's really happening. You might need to go and visit the asset and understand what's going on. Or at times your asset may be fine, but they may have problems on other properties and they're getting stressed from that, and they may not be giving your property enough attention. So understanding is the operator stress, and I've seen this too. Your project is fine, but the operator is stressed because they have loan maturity on another loan and they need liquidity there. And your project is fine, but they are stressed, which is not necessarily a bad problem. Not as bad of a problem, but you still want to make sure your project is getting enough attention. I hope it helps.
Yeah, no, solid insights, Mike. Really appreciate that. One thing I think we should kind of put in perspective for investors, right? I mean, a lot of us who are investing in real estate, right, we're kind of living in this bubble a little bit, right? Thinking about all these things that are kind of dynamic. But again, let's put on our investor hat and think about all the different asset classes that a lot of people have. And frankly, still the majority of folks out there have a majority of their portfolio holdings sitting in government-sponsored qualified plans or in stocks, bonds, mutual funds to some extent. So the S&P was down just about 20% last year. And, if you had, let's just take 100K. If you had a 100K in your 401k, it was down 20%. You actually need to make, that you'd be then down to 80,000. So the following year, you actually need to make a 40% gain, just to, get back if you're going up again 20%, right? It's 20% just to get back to where you were, right? So it's interesting to kind of compare and contrast, right, asset classes and kind of think about on a relative basis, looking at your portfolio, right? You talked about some of the inherent risks, right, of real estate and everything, but, what are your thoughts with, that compared to, equities markets?
Sure. And a full disclaimer, I'm not a specialist in equities market. I have my opinion on that. And listen, equity markets have a lot less predictability than real estate. There's a generally greater volatility. And as you rightfully point out, you may have a 20% down year. The next year, just to break even, you have to get up 25%. If you lost 20%, so if you're down to 80,000, like you said, now to get to 100,000, just to break even over 2 years, you need to go up by 20,000, which is now 25% relative to the 80,000. In general, this is what I think about the stock market. The balance sheets are overloaded with cheap debt. The same problem real estate has. Many corporations are known as zombie companies. They simply don't turn in NOI after debt service. They basically continue to just stay afloat. Whatever income they make, they just service the debt. And when the debt is up, the debt service is up substantially as a result of high interest rates, it's a massive choke. So a lot of corporations will face, let's just call same, maybe even worse problem that the real estate faces by virtue of having too much cheap debt in the past. And now the debt has to be rolled. Maturing is a substantial, it's probably a bigger problem than in real estate. But there's something to keep in mind. So would I rather be in a stock market with a lot of uncertainty and let somebody else control what happens versus private real estate investing? I would rather be in private real estate investing. Also, I just put together a very short educational video. This comes really fresh to my mind. And in that video, the question was compare Wall Street traded real estate investment REITs versus private funds. And there are many differences, right? One, what they invest in, they usually invest into more stabilized assets. They try to invest for income versus in the private real estate, you can invest into income, you can invest in growth, you can invest growth in income value. Yeah, there's a lot more flexibility. But there's one gigantic difference between the two. One, when you invest in Wall Street, you don't get to know, like, and trust people you invest with. You're investing in some 40,000-pound gorilla. Either it's a REIT with corporate executives, or it could be a publicly traded company that you just don't get to know the management. You're too far away from them no matter what. Unless you're a gigantic investor, you'll never get access to them. With real estate, you have real experience touching people, breaking bread with people, networking with people, understanding executive teams of these private real estate fund management companies or real estate syndicators. From my perspective, it's a lot better experience for you as an investor. And as a fund manager, I want to know who I invest with, because we operate a model like an investor, fund to fund. So we write checks into our other deals. We basically, our rule of thumb, we need to know, like, and trust people we invest with first. Second, what deals they invest in. Okay, do we like those deals? Can we negotiate the right terms? And then 3, how much capital we will deploy in those deals, depending on the first 2 elements. So that whole element is gigantically better in real estate versus the stock market. You just can't, unless again you're writing $1 billion check or some large check. You're not going to go shake a hand of Jamie Dimon or another corporate executive. They just gigantic players relative to most of the kind of average Joe investors.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, for sure. And I think also being in the alternative space, right? We're really aligning where the fundamentals are very strong. So I still think if you look at the fundamentals of, commercial real estate right now, I mean, there is still a massive, I think by 6 million homes shortage, right, that we have across the country. And then you take that even further into some of these Sunbelt states and the markets where a lot of people are really expanding. So, there's a need, right? There's still a very strong demand. And in some cases, right, the recessionary times is even driving more people into that. So for instance, I mean, look, I've got kids who are trying to, buy their first time house. Well, with interest rates at this point, they're not going to be able to do that. So their only option is probably to rent, right? Or they're looking at states, states that have no taxes, like Florida, Tennessee, right? Texas, right? Some of these states. So you have even more of a migration with some of these things. So I think the fundamentals remain strong, but it's interesting, a lot of the points you point out are really salient around really, protecting your downside and operationally, right? How strong is that team that you're investing in, right? What would you think, from that perspective?
Sure. So let me continue your train of thought. For sure, they cracked this joke. Recession in Florida? What recession? It ain't going to happen, so people say, because there's so much inbound migration, and the same is happening on many other states, including Texas. So I concur with your opinion that during a recession, and especially with the somewhat high interest rates environment, there is greater demand for rental housing, especially affordable. Affordable multifamily housing has seen substantial growth, and there's not enough supply. That is a fundamental shift. During recession, people substitute down. You can't afford a bigger place, you rent a smaller place. You rent an apartment instead of a house. You still want good location. You still want to be in good school, but you're okay to live in an apartment instead of the house if you can't afford the house. And this high interest rate environment has actually been good news for rent increases. It actually triggers rent inflation, accelerates rent inflation from that perspective. So certain asset classes in commercial real estate continue to look attractive in this environment simply because they have strong fundamentals during a recession, like affordable multifamily housing or some level of storage. Some other asset classes look a little concerning. If you have office space or if you have potentially, retail has been kind of interesting, right? There's some open door retail and people love to come back after the post-COVID reopening. And then there's closed door retail that might continue to be dying out over time. So you have to be a lot more careful in that asset class. Industrial continues to do well. There are great opportunities even in a recessionary environment. There are some niche strategies that we've invested in that continue to do really well. Give you examples. So we've continued to invest with guys called discountlots.com. They buy land in the boonies, kind of recreational land, and then they sell it to investors as receivables, and for 5-6 times the price they pay for it. So it's an example of a niche strategy that completely isolated from high interest rates because the rates doesn't even matter. So the reason I brought it up is just it's in the investing world, there are opportunities that don't necessarily depend on market condition, and they don't depend on cycle as much. But going back to your statement about location, of course, these southern states with inbound migration in the long run will continue to do well. But also you need to look at also our affordability. So affordability has been a substantial issue over the last couple of years with rapid inflation. So looking at where the incomes are and where the housing is affordable relative to the income level is important too. So we've done deals in suburbs of Detroit, and people might say it's not an exactly sexy market. Well, it's not, but the housing is so affordable, and if you're creating a great product in the market or you're innovating great properties, the investment by itself may be a phenomenal investment because you are producing a very affordable, higher quality product. So investments by themselves need to be, every real estate is local. No matter what people are going to say, you may have a great investment in a terrible market, or you can have a terrible investment in a great market. So I just wanted to separate that the deal selection with the right operator, with the right strategy, often matters more than purely, hey, let's write a check in Florida or in Texas. And we've seen, give you an example, Austin has been a super hot market. And I was just in Austin a couple of weeks ago, and I met with a local developer, and he thinks that the Austin is going to be isolated from any kind of recession. And I certainly respect the opinion. But the data is telling me that the market is so not affordable that it's going to be difficult to believe that there isn't going to be a price correction in that market. So some of the forces of general forces of supply, demand, and affordability going to play in the recessionary environment, especially if the prices have gone up so much in the past. So at the end of the day, reversion to the mean will happen in the long run. That's kind of my view.
Sure. And so what do you think really looking forward, right, past 2023? What do you think in terms of the future of real estate and where the industry is headed?
So it's a great question. I appreciate the question. I would say that I'm a firm believer that U.S. economy can't afford high interest rates for too long, although the Fed has made every point to say they're on a mission to fight inflation, and they're not done raising interest rates. And one of the important points, Fed has shown over many economic cycles they're late, almost always late. I don't want to say this categorically always late, but they're very, very often late. And here's an example how they're late. They're still raising interest rates now, the Fed funds rate, they're still raising it, while the 10-year Treasury is already signaled that it's peaked out. This is my opinion. I may be wrong. The 10-year Treasury may still go up, but 10-year Treasury peaked at about 4.25, and it's down to about 3.5 at the time of the recording. My view, it sort of peaked at 4.25. I don't think it's coming back up there. So what my perception is of the market is they will still execute one more maybe rate increase. They'll push the rates another quarter, and I think at that point they're done. They've already inflicted too much pain on the market. So as they keep the rates for a long time at this restricted level, this restrictive policy is going to continue to put pressure on the economy. These maturing loans, as more time passes, the bridge paper, the corporate debt that matures now needs to renew at a higher rate, or value add project with the bridge paper maturing, a new mortgage needs to be obtained, or rate cap is another fresh pressure point, but it'll happen in 6 months from now. So what I see happening is probably Fed keeping the rates where they are through the end of this year. Maybe if there's enough pain in the economy, they'll start cycling it down. But on a long-term basis, U.S. economy just cannot afford interest rates where they are right now because of a level of debt relative to the size of the economy. We've just ballooned the overall debt. I'm not saying we're moving to the Japan model. That's many years away. Japan debt to GDP ratio is out of control. It's been out of control for a long time. Nonetheless, we still have a lot of public and private debt relative to the size of the economy that can't afford high interest rates. So as long as they don't do anything crazy from a fiscal policy perspective, like what they've done, printing trillions of dollars to fight COVID, which created a lot of dollars in the economy, and that created substantial inflation. Obviously, supply chain created issues that created inflation, but more dollars in circulation, $10, 10 apples, you make $20 and 10 apples, it's twice as expensive for every apple. That's the basics of the inflation. So if you go back now and you think about where we're going, we're certainly going into some level of a recession, second half of the year, and probably good portion of 2024. So most recessions last somewhere between 12 and 18 months. If you follow the projections that the recession is likely going to happen second half of the year, and you add 12 to 18 months on top of that, you're probably looking into recession continuing all the way through the end of 2024. Now, what kind of recession and the severity and what the opportunity is going to look like, we don't know for sure, but folks need to be prepared. The fresh cash could start finding home soon if there are great deals coming. Very important point. So if you believe the rates will cycle back down, then the opportunity to buy is now or in the upcoming months and quarters. The reason for this is the good old rule of investing. You typically buy real estate when the rates are high and you refinance or sell when the rates are low. That typically, again, lower interest rates, lower cap rates, better for sales, or better for refinancing. So conceptually, if the great deals are coming in second half of the year, maybe even earlier, and you are an investor and you're looking to write a check, if you can actually confidently say why it's a great deal. This is the first question I ask anytime anybody brings me a deal today, why it's a great deal. And if they can't explain why it's a great deal, then it's not a great deal. And if it's not a great deal, am I really motivated to write a check right now when I see better deals coming in the future? And the answer is no. But if there's a great explanation why it's a great deal today, simply because, hey, rate cap maturity hit, the seller didn't finish renovation, they're out of cash, and you can actually understand and verify and justify that whole thesis, then you can write a check into a great deal at the higher interest rates, and when they cycle back down, it's an additional wind behind in your back.
Yeah, I think you really nailed it right there, Mike, right? It's really buying assets, right, that are undervalued. I mean, it's the first place you make money, right, is on the buy. And if you're looking at, today's interest rates, conservative projections, and you find a great deal, it is a good deal. Yeah, so and I think we're starting to see some of that happen in the market, some creative things kind of going on, but some good, underlying fundamentals, right, that are really driving that. So I think investors that are poised to take advantage, in this market, and I think also investors should really keep that long-term view on. And unfortunately, the equities markets get us all positioned to be, kind of reactive, right, and looking at things almost on a daily basis. But that's what's great about the real estate asset class and some of these others, that you can kind of think, like the wealthy do, right, which is long term, right? They're making decisions for the long term and based on the fundamentals. So really good thoughts there, Mike. If you could give investors just one piece of advice about how they could really accelerate their wealth trajectory, what would it be?
So before I do this, let me add one more comment. Just kind of a thought that has crossed my mind. So one, in relation to what you just said. So be a long-term investor versus short-term. That's probably a great advice. So thank you for saying this, and I'll support that. But I'll tell you this. So what comes to mind is I was just analyzing the past, and we're way ahead of a real recession and a real problems yet. At the same time, when I went back and I decided to study and just think about what has great investors done, or the greatest of all investors, at least the Oracle of Omaha, Warren Buffett, has done during the crisis 2008. It was one of the best ways to think about this, just go back and see what people have done. So when he says, when others are fearful,
when others are greedy,
and when you got to be greedy when others are fearful. So what he did is just a quick comment. He wrote a $5 billion check into Goldman Sachs when the market, everything was in panic. They were in September 2008. And he wrote a check. There's basically 7 lessons that I could talk about. And some of them, you asked me what are good advice, but learn from Warren Buffett. So $5 billion check into preferred equity instead of common equity. Lesson number 1, invest with downside protection, right? Downside protection, preferred equity is safer than common equity. And we do this today with the structures where investors can actually invest a check into preferred equity versus common. Preferred equity has greater downside protection than common. So he wrote into preferred equity with 10% yield. Lesson number 2, when you invest, if you can, get some cash flow today and get some upside tomorrow. So he did get his 10% per year dividend yield. Not easy to do, but he did get it when the market was in a down part, right? He also got he required that if Goldman Sachs were to buy out that preferred equity, they'd have to pay him $500 million as an exit fee. So he basically bought a minimum prepayment penalty on the deal. Now, it's not that everyone can exercise it, but he did it just as an example. On top of that, he got phenomenal upside. He got $5 billion worth of warrants to buy Goldman Sachs stock for $5 billion at a strike price below the market. It was ridiculous. The deal was so obscenely good, but it was done. So another lesson is done. If your name is Warren Buffett, you have strong reputation, and people approach you for money, you have the negotiation leverage. So if you have track record, if you're a known player, people approach you, you have that ability of pricing power because your name is reputation, right? That's another lesson learned. At the end of the day, he also got great upside. So when you invest today and you can get good downside protection, can you also get a great upside, right? Another lesson learned: if you find a great deal, don't be shy to write a check, right? So he wrote a gigantic check, but at the same time, he knew his level of risk-reward ratio was just so healthy that he could write a big check. So the reason I'm giving you this, because you're telling me what is the greatest lesson, I just given a whole bunch of them.
Yeah.
Think like Warren Buffett, act like Warren Buffett. Can you always get that kind of a deal? Probably not. Nonetheless, thinking like this helps. So when you negotiate a deal, when you are looking at the opportunity, can you get any of these elements? Anyway, we have a newsletter that just came out with that article. If folks want to get a copy, they could probably go on our website, and they have 7 lessons outlined from that lessons learned from 2008. And then going back to private real estate investing versus public. And you said this, and I love this, right? Public REITs and any public stock, they live quarter to quarter. If they don't report good numbers for one quarter, they get crucified. The investors start selling the stock, they get nervous. The big difference in real estate is you have to be a long-term investor. So you have to look behind the scenes, you have to look behind a short-term performance and understand, is this a good fundamental investment? And if it is, don't be shy to write a check.
Great. Mike, thanks so much for coming on the show today and providing so much value to the listeners. Really appreciate it. I know everyone's going to really enjoy those insights. If people would like to connect with you or learn more about what you're up to, what's the best place?
It's a little cheesy, but I'm known as the Big Mike, and the name stuck. I'm a big guy. I'm 6'4" on a heavy side. There's just no other way. People have been calling me Big Mike forever. So I'm a fund manager. So it's a bigmikefund.com. Really easy to remember. bigmikefund.com. However, if you forget the D at the end, if you heard bigmikefund.com, I promise it's not a kinky site.
Perfect. Mike, thanks again. Really appreciate the time. It's been very insightful, and look forward to speaking again.
Thank you, Dave.